We're going to move on to subchapter B and the general accounting rules. I mean, so now that we've kind of established this general rule of a 12% value added tax, we've got to flesh out some of the details, and that's what these other chapters are for. This is the kind of stuff that the lobbyists get paid big bucks for, is to sit there in Congress and in Washington and make sure that there's loopholes for their clients. But the Phoenix Congress model turns it around and says, look, we're gonna write the details outside the swamp of Washington and make sure that it's all done openly upfront, that everybody knows what we're getting. And it's important for us to actually get into these details here. So most of these sections are very short. I'll just touch on each of these briefly. Section 1611 is general accounting rules, which is basically the default is to use the accrual method, accrual basis for bookkeeping, which means that business purchases, it's when you incur them or when you incur them or when you send out a bill, even if the other company hasn't paid you yet. When it's on your books, that's when you treat it as an expense or as income. Section 1612 says that the use of cash accounting method is still permitted. There are some businesses that use it. It's unusual, but if it's currently permitted under regulations, then you can still do it, and the secretary will have other regulations needed. Taxable year, we touched on this a couple times in the previous subchapter. Taxable, we're going to start this January 1st, 2024. So I want to get everybody on the calendar year as a taxable year. You probably know the United States government uses a fiscal year that is not the calendar year, but for other businesses, try and push them in that direction for simplicity's sake. So define how that works. If they are on a fiscal year that is not the calendar year, then it would set up a short taxable year that would end December 31st. So if you were on the same calendar as the federal government and start your taxable year in October 1st, then you would have a short taxable year in 2023 where that year would end on the end of the calendar year and then start a new one on January 24th, 2024. This entities that use a weekly, do their accounting on a weekly basis instead of monthly or yearly, would still be able to do that if they're permitted under existing rules to have a 52 or 53 week taxable year. And there's an anti-abuse rule, so you can't abuse any loophole with taxable years that don't line up with the imposition of the value added tax. Section 1614 deals with term contracts. These are contracts that take place over multiple tax years, and it sets out when contractors and things, how they'll treat these things. Section 1615 deals with adjustments and refunds. If you've put a sale on your books and then the guy never pays you, you can go ahead and make adjustments if it's even if it's in the different taxable year. Bad debts, same thing. If you write off a bad debt and then you actually end up recovering it, then you got to treat it as a taxable receipt when you collect it. So those are some of the basic accounting rules, and I think that concludes my testimony for subchapter B. Subchapter C is dealing with financial products and services. The value-added tax is pretty straightforward when we're talking about something tangible like a car or something like that. But what about financial services, where like the business entity is a middleman? That's what subchapter C deals with. Once again, we got the definitions in section 1621. I think we'll just I'll jump back up to them as they're appropriate. But 1622 deals with the sort of the general rules that gross profits, how you calculate gross profits. Instead of taxable receipts, we use the definition of financial receipts and include financial expenses as business purchases. So let's look at what financial receipts. Financial receipts means everything, and financial expenses includes paying out, like if you're an insurance company, paying out for financial expenses, includes payment on principal and interest, things like that. Some businesses they do more than one of these things. You might think of like a car dealership or something that sells physical products, but also, makes loans and stuff like that. And so if there's a separate business activity, section B here says that'll be considered a separate business activity, and it'll be considered a separate entity with respect to such activity. So that's how that would break out for businesses like that. We've got special rules for banks in section 1623, clarifying again what those financial, kind of defining what is a bank, what their financial receipts would be. So all their taxable receipts, the interest that they're making, anything that they're making on the sale of loans, any discount points, any other explicit fees, those are all financial receipts that would be subject to the value added tax. And as far as their expenses, that's things like the interest. And for when it comes to foreclosure property, making sure that they take that into account for their gross profits. And then our definition here of bank, this kind of includes a lot of the things that we covered in the Treasury dollar bills. But if a bank is engaged in significant amounts of activities other than those described in paragraph 1, it should be considered as a separate business entity with respect to other activity. So if you're a bank who does lots of buying and selling of other products besides financial services, then that's to be treated as a separate taxable entity. 1624, pretty much kind of the same thing, treating insurance as a financial intermediation service. And if you get inconsistent results, it's inconsistent with the territorial approach of the value added tax, then the insurance company can ask the secretary to apply a different set of rules. Section 1625 deals with financial pass-through entities. They're legal entities that are like sole proprietorships and things like that, where the money generally goes to individuals as opposed to a corporation. And so financial receipts, if you're putting money into your business, that can be included as a financial receipt. And then those distributions, if you take money back out of the company for yourself, then that can be those things count as receipts and expenditures. Yeah, I think that concludes my testimony for subchapter C, and happy to answer any questions.
Thank you. Do credit unions count as banks under this subchapter?
Yes, they're included as long as they're subject to state or federal authority. Then yes, they're included.